Hello everyone, welcome back to my channel. If you're new here, my name is Audrey, Rozier, your guide to real estate insights in the Central Maryland and Baltimore metro areas. In today's video, we're actually going to be exploring the concept of assumable mortgages and what that could look like for you. So this type of financing is an arrangement where you can, as a buyer, take over the existing mortgage of a seller. It's a path less traveled in home buying, but in certain situations, it can be very advantageous. So let's dive into what assumable mortgages are, their benefits, potential drawbacks, and how they work. Stay tuned. First off, what is an assumable mortgage? It's essentially a financial setup where the outstanding mortgage and its terms, like the current principal balance, interest rate, and repayment period, are transferred from the current owner to the buyer of the house. Now, this would mean that you're not getting a brand new mortgage, but rather taking over the existing one. And of course, this can be particularly appealing when interest rates are on the rise like they are right now, or if the seller has locked in an interest rate that's like substantially lower than what's currently available. Honestly, assuming that their mortgage could be a significant savings for you, it works out. Now, not all loans are assumable. Typically, this option is available for Federal Housing Authority loans, which is FHA, Veteran Affairs loans, and U.S. Department of Agricultural loans, so that's USDA. Now, each have their specific requirements as well. For FHA loans, the property must have been the seller's primary residence, and both parties must meet the FHA's assumption requirements. VA loans offer an interesting twist. Now, you don't have to be a military member to assume such a loan, but approval from the lender and the VA is still required. Now, for USDA loans aimed at rural property buyers, they also allow for assumptions but come with their own set of qualifications like credit and income requirements. Now, let's talk about the pros and the cons. First up, the pros. The first pro we're going to talk about, of course, is something we just mentioned, but it's going to be potentially a lower interest rate. One key advantage of assumable mortgages is the potential for considerable interest savings. Now, of course, this benefit comes into play when the seller's mortgage rate is lower than what current rates are today. By taking over their mortgage, you lock in this lower rate, which can lead to significant savings over time. So if you consider a scenario like this, where the seller's interest rate is 3.5% compared to the current market rate, which I think is 7 or upwards of 7, assuming their mortgage means you adopt the lower rate, reducing both your monthly payments and the total interest costs across the loan's lifespan. For a substantial loan, even a small percentage difference in interest rates can amount to substantial savings. Next is going to be reduced closing costs potentially. Assumable mortgages often come with the benefit of reduced closing costs compared to new loans. This can translate into savings on various fees, typically associated with a new mortgage, such as underwriting and origination fees. However, it is important to note and to be aware that some lenders may charge an assumption fee or a fee to transfer the existing mortgage to a new buyer. While this fee can vary, it's an additional cost that needs to be considered when calculating the overall financial implications of assuming a mortgage. Despite this fee though, the total closing costs for assumable mortgages can still be lower, but it's crucial to factor in all potential expenses to get a complete picture of the cost and benefits. Next up is going to be the streamlined process. Assuming a mortgage can sometimes be quicker than obtaining a new mortgage, as a part of the lending process is already completed. It's also important to note that this isn't always the case. In some instances, the process of assuming a mortgage can actually take longer than obtaining a new mortgage. Traditional mortgage approvals might take around 30 days, but the turn times for assumable mortgages can extend as long as 90 days. And honestly, this extended time frame is due to various factors, including the need to meet specific lender requirements, the approval process from the agency backing the loan, and the overall complexity of transferring the loan. Therefore, while assuming a mortgage might initially appear like a shortcut, it's essential to prepare for a potentially longer journey towards homeownership when considering this route. Now, next, let's talk about the cons. First up is going to be qualification requirements. Qualifying for an assumable mortgage mirrors the process of securing a new loan. So you do have to meet the lender's criteria, which typically involves a comprehensive credit check and verification of your financial stability. The thoroughness of this process is comparable to that of applying for a new mortgage. Essentially, the lender needs to ensure that you're capable of taking on the existing loan, just as they would with a fresh mortgage application. Next is the potential for a substantial down payment. A very, very key consideration in assumable mortgages is the potential need for a substantial down payment. This situation arises when there's a notable gap between the selling price of the home and the remaining balance of the seller's mortgage. In some cases, you as the buyer will need to cover this difference. This might involve making a large upfront payment or securing an additional loan to bridge the gap. The extent of this financial obligation depends on the equity the seller has in the property and, of course, the remaining balance on the mortgage. Now, next is the risk that you'll have with two potential mortgages if you decide to go that route. Now, when assuming a mortgage where the seller's equity is high, high, you may need to take out a second mortgage to cover the balance if you don't have the money in cash. Now, juggling two different mortgages can be a complex and risky process. Now, this is especially true if the second mortgage carries a higher interest rate, which can increase your monthly financial burden and the overall risk of default. The complexity arises from managing two separate loan agreements as well. Each will have their own terms, rates, and repayment schedules. Next is going to be the assumable mortgage transfer approval. Now, it's crucial to understand that the decision to transfer an assumable mortgage doesn't solely lie with the buyer and the seller. The lender of the original mortgage must approve the assumption. The buyer must apply for the assumable loan and meet all of the lender's requirements, which typically include having sufficient assets and being creditworthy. Even after the mortgage is assumed, the seller could still be held liable for any defaults unless they obtain a release of liability from the lender. Now, this is a critical point for both parties to consider. Next, let's talk about understanding what is assumable and what's not assumable. Now, it's essential to know which mortgages are actually assumable. USDA, VA, and FHA loans all fall into this category, each with specific eligibility criteria. Now, in contrast, most conventional loans, particularly those backed by Fannie Mae and Freddie Mac, are generally not assumable, though there can be exceptions made for certain types of adjustable rate mortgages. Now, if you're considering assuming a loan, you first need to confirm with the seller and their lender if the loan is actually indeed assumable. Now, this step is very crucial to avoid any misunderstandings later in the process. In conclusion, an assumable mortgage can be a very favorable option when current interest rates are higher than the rate on an existing mortgage. It typically offers the advantage of securing a lower rate and, in some cases, can reduce the amount of paperwork and fees involved. However, it does not come without its challenges. If the seller has significant equity in the home, you as the buyer may face the need for a large down payment or the complexity of securing a second mortgage for the balance that is not covered by the existing mortgage. Now, before deciding, you need to consider all aspects of assumable mortgages. Ensure that you're fully aware of all the requirements and potential risk involved. And if the benefits outweigh the risk, and if you meet the criteria set by the lender and the relevant government agency, an assumable mortgage could be an excellent path to homeownership for you. Thank you so much for taking the time to join me to explore the ins and outs of assumable mortgages. If you have any experiences or insights to share or have questions about this topic, please drop them in the comment section below. I always enjoy hearing from you and learning about your experiences. Also, don't forget to visit my website for more resources, including my free home buyer's guide. And of course, if you found this video helpful, please like and share and subscribe for more real estate advice and insights. For specific or personalized assistance, or if you're considering selling your home, feel free to reach out to me as well directly. You can schedule a call through my website as well. Thank you again for taking the time to watch, and I will see you on the next one. Bye.